So we see the organization set their financial goals. So to comply or to align with their financial goals, what they do, they prepare a number of budgets. So it can be budget for how much I'll be selling, how much I'll be producing, how much expenses I'll be incurring for direct materials in this way. So altogether, if I integrate all the budgets, sales budget, production budget, direct labor budget, direct materials budget, altogether they create an integrated business plan. So that is known as the master budget. Okay. So here our topic of discussion is right now understand why organizations make budget and what are the processes they use to create the budget. Okay. So this is a detailed quantitative plan for what purposes? Obtaining and utilizing financial resources and other resources, and budget is prepared for a future that's why it is forthcoming, and it is for a specific time period. And the specific time period is generally 1 year period, but it can be different from 1 year period. It can be any period. So which I'm trying to highlight, that is it is for the future and it's for the specific time period. Okay. But another way of preparing budget other than specifying a 12-month period or 1 year period, that is rolling forward. So what is this rolling forward? So it is a kind of, your budget will contain a budget for a specific number of months, but when 1 month has been completed, or out of the 12 months, you already have faced the 1 month, so you have the remaining 11 months, but one additional month from next or forthcoming will be added, so that it will be continuously 12 months. Okay, so that is the idea of rolling forward, nothing special. So continuous budget is a 12-month budget. It is also known as the perpetual budget that rolls forward 1 month or quarter. I gave you the example in terms of month. It can be quarter. Say in a year we have four quarter. So there are quarter 2, quarter 3 in this way. But you see that if it has elapsed, you already have faced it. So you add another key quarter. So that should be quarter 1. But altogether, you see, it is still a 12-month budget period. Okay, or it is a 12-month period. That is known as the continuous budget. So usually the operating budget, which involves the sale, production, this budget usually cover 1 year period, and it is directly connected with the company's fiscal year. So if the company's fiscal year is from July 20 to June 20 something, the operating budget should cover or should align this period. Okay. So let's remind ourselves what we have learned in the very introductory concepts of managerial accounting. So we heard about these 2 concepts there. So budgets mainly serve these 2 purposes. One is planning, and the one is controlling. So in planning, how budget helps us? It helps us in this way. We already set some objectives as a part of planning, and for achieving these objectives, we prepare the budgets. Okay, so we have to allocate the resources to achieve the objectives. So that is one way. And another way is that we like to achieve some objectives, but we like to make sure that all parts of the organization, including the employees, including all the divisions, including all the activities, are working in a way so that we can achieve the goal we set in the planning stage. So budget is a way that helps us for the controlling purpose, that management can look at or management can make sure that organization has the adequate resources, or all the functions or all the divisions have adequate resources, so that they will be working for or they will be working for achieving the goal. Okay, so other than these two key purposes, there are other purposes which are more general, and these are here we are terming as the benefit. So we like to highlight at least two of the benefits, that is uh, throughout the budget, you like to define your goals and objectives. So you share your throughout by preparing the budget, you actually quantify, or you actually try to reflect in quantitative terms what are the goals and what are the objectives. How much sale you like to achieve in a year, or how much like sale you like to achieve in a quarter. And it is also possible throughout by the help of budget, you communicate with the executives or other people of the organization regarding your planning. And this is a critical mean, or is a document which shows you that how to allocate the resources, or and how you are actually allocating the resources. Okay, so in this way we try to identify the benefits. But let me ask you uh, that other than these benefits what have been mentioned, uh, every month you make a budget for your expenses, for your monthly expenses. So if your budgeted expenditures in this month, April month, say for example 5,000, but your parents is providing you 4,500 every month, in that case how you will manage this 500? What will be your options? Write in the chat box what you do. You will reduce expenses of 500, or you will do something else. You will reduce the expenses. That may be your option, but is there any people who has different opinion? Generate a temporary earning sources. How it is possible? Could you give me an idea so that we can all utilize that? Something, take a freelancing work. Who live in hall, they find it very popular that I'll do an assignment for some people and make money of this. That is additional. How you will create your earnings? Okay, but we can do a tuition for a month. Okay, just I like to know from you, don't you borrow from your friends money? Don't you borrow money from your friends, or from your hallmates, or from your roommates? I used to borrow most often from my friends uh, who used to do a number of tuitions. They have a good amount of cash flow every month, but I was not allowed to make tuitions from my family. So that's why I didn't have much cash. Yeah, so you do borrowing. So what I was saying, that based on the budget, you can also identify that if you need to make some additional borrowing, it can be pre-planned. It's not like that you just have uh, realized that your expenses is over the expected income and you plan to make borrowing. In that case, you'll find it difficult. So you have to think it before facing such situation where you need borrowing. So there is some benefits which has not been pointed out, but you need to think of this. Okay, now other than the point which are more related to the planning, from the control perspective, budget helps us to improve the efficiency. So when we have a budget, we like to utilize the resources in a best way. So we like to reduce our unnecessary expenses, so that enables the efficiency and effectiveness of operation. And it is also possible that when you make an expenditure which is lower than the budgeted expenditure, in that case, the reward can be provided to the employees. And it is only possible if you have a budget, you know that what was his allocated expenditure and what has been, what are the expenses made by him. Okay, so companies usually create budget following some ways, but we like to highlight two issues that are two ways that how company or organization prepare budget. So one way of preparing budget is that they make self-imposed budget or participative budget. So what is this? Organization ask the managers from all levels that how much expenses or how much production or how much sales or how much levers you are expecting to or you are expecting will be required for us for this period of time. So in that case, you are seeking opinion from all levels of managers. So there is the idea of self-imposed budget or participative budget. But other than this self-imposed budget or participate budget, we have another approach that is the top-down budgeting. So here from the name, it implies that you will not look for more participation of managers at all levels. Rather, the top managers or top executives will tell you that how much expenses you can make, or what should be your sales target in this quarter or in this month, and how much inventory you can have. In this way, the top managers are dictating all of this. Okay, so between these two ways of preparing budget, I hope that many of you will be agreeing that self-imposed or participative budget is has more benefits compared to the top-down budgeting for a number of reasons. Okay, so this is a just graphical depiction that how the self-imposed budget works, and you see the supervisor from all the divisions or the functions are giving the input in this way. The red line tries to identify, the red line is indicating the self-imposed budget. But if the line is in this way, the top management is giving in this way the down arrow. In that case, it will be kind of the what I said this way, the top-down budgeting. Okay, so what are the advantages of self-imposed budget? So you are showing respect to the opinions of whom? The lower level managers who are involved, because they are involved in the budgeting process. And you know that these people are directly engaged in the functional activities, and you're taking opinions from them. So your budget is likely to be more accurate, and they get more motivations because they are helping you to set the goal, and they are providing their inputs. Okay, and it also creates empowerment among the organization, because the managers in the lower level or the front line, they feel that their opinions are evaluated, and the top managers are listening to them. Okay, so there are issues that when self-imposed budget is done, So one way is that what is done, say there is a concept which is known as budgetary slack. So budgetary slack is like that. Say for example, from the expenses part, say managers has allocated expenses of 10,000, but actually the expenses which happens is 8,000. So you see that 2,000 gap, there is a difference of 2,000. So allocating more expenses than the required expenses and estimating lower sales compared to the reasonable sales figure are some examples of budgetary slack. So the budget which is prepared in a participative way or self-imposed way need to be reviewed by the higher level management or top level management to avoid the budgetary slack. So to check this issue, okay. So these issues can be avoided if the self-imposed budget is reviewed by the top management, okay. So as I was saying in the introductory part regarding the master budget is not a single budget, it is a collection of budgets. So it is a collection of separate budget, but separate budgets, these budgets are interdependent. So you see a number of or numerous budgets here, and altogether they are independent, and altogether they are known as the master budget. And master budget consists of numerous separate, but the idea is that they are independent. So you see, I'll not explain each of these budget. The name implies that what the budget is whatever. But let me ask you that if it is the sales budget, what do you expect from the sales budget? What you want to show in the sales budget? So by making the sales budget, you like to answer what kind of question? Write your responses in the chat box so that I can check that you understand that for what purpose the sales budget is prepared. So we like to know for a budget period, what will be our forecasted sales, and what are the sales in units, and what amount of sales in terms of dollar, and how much sales will be made in quarter, these things. So this will be depicted in the sales budget, okay. And similarly, the follow-up budget after the sales is the production budget. So you see that production budget should be prepared after the sales budget, but what it will depict? It will depict the number of units which must be produced during the budget period. For what purposes? To meet up the sales demand. So if we do not know what amount will be the sales amount, we cannot define what amount should we produce, okay. But let me ask you that if the company is a merchandise company, that company should have production budget or different one? If the company is a merchandise company, I can recall that I defined the merchandise company or merchandise concept in one of our classes. So what kind of budget you expect after sales budget if it is not the production budget? If it is not the production budget, what budget you expect after the sales budget? Yeah, absolutely, the purchase budget. So the purchase budget should be here. So as the company is a merchandise company, they should purchase, they will not go for producing. Okay. But if the company is a producing company or the manufacturing company, after the production budget, there will be the direct materials budget, there will be direct labor budget, there will be manufacturing overhead budget, there will be ending inventory budget, and altogether will enable me to complete the master budget. Okay, and all budget here you see will help me to prepare the cash budget, and cash budget will finally help me to prepare the budgeted income statement and the budgeted balance sheet. You are familiar with the income statement and balance sheet from the financial accounting. Note that those income statement and balance sheet are historical income statement, historical balance sheet. But here we have the budgeted income statement, budgeted balance sheet. It can only be prepared if we have the cash budget. Okay. So you already have identified each of the budget answers what kind of questions. Okay. So let's try to explore what questions will be answered by each of these budgets. Say, for example, the direct materials budget. Okay. So this budget will give you the answer to what kind of question. Okay. So let me take you here, direct materials. How much raw material will we need to purchase? It is from the purchase budget, but again, it will also help me to know the direct materials budget, how much raw material we need to collect or we need to procure. Okay. So as I mentioned, or as we discussed, the sales budget will help us to give the answer to this question: how much sales revenue will we earn? Okay. So usually Microsoft Excel is created for preparing these budgets, what we have seen. And for preparing the budget, we need to make a number of assumptions. And those assumptions are usually written in the Microsoft Excel. So what kind of assumptions we will be making? Say, for example, we have an estimated price for the unit, So we have estimated selling price, and we have the estimated unit sale, and we might have some estimation in this way, that out of the sales, how much or what percentage will be the accounts receivable, and out of the purchases, what will be the amount of accounts payable, and out of my sales, what percentage will come from the beginning inventory, what percentage will come from the current production, and out of the current production, what will be the percentage which will be in our ending inventory. Okay. So these are the some assumptions we'll be using, and this should be inserted, or this should be added in the Microsoft Excel in a separate sheet. So that will help you to prepare, or that will help you to apply some command like what if. Based on the assumptions, you can apply the formula or command like this, what if, most commonly used. So let's work on a budget. Starts with a sales budget. Okay. So we'll try to know that how budget is prepared. Try to understand very far before going for the budget. That is, in reality, the budget is a huge task. So Microsoft Excel is used, and here in this course part, we'll try to simplify the context for our constraint. And in the exam, you will also see a limited picture, not the big picture of the reality. So, but as far as you know the idea, you can work with the budget of any size. It can be for a company which has a sales of 10,000 units, or a company which has 10 billion units. Okay, but the idea is fairly straightforward. Okay, so let's work with the company. Royal Company is preparing budgets for the quarter ending June 30th. Now, let me ask you, if the quarter ends in June 30th, quarter starts from which month, which date? This quarter, which ends in June 30th, this quarter starts from which month, which date? Very quick, I look for your responses. I'm looking for your responses. July 1st. Try to understand, the quarter ends in June 30th. So the quarter should start from April 1st. So each quarter is 3 months. So it should start from April 1 and it should finish here in June 30. So you see 3 months. Okay, 3-month period. Okay. Now we have some sales figure, budgeted sales figure for the next 5 months, April, May, June. Note that these are part of our quarter, this quarter, and this will be required. You will see for our calculation, and the selling price is $10 per unit. Assume that we are working in a spreadsheet. This is a screenshot of a spreadsheet. Try to understand that this will be real workings in the spreadsheet. Okay, so what we'll have to do, in our first row, we have to identify the period. So our period is here, the April to June, this quarter, and this is the quarter total column. Okay, so we have identified our time period here, April, May, June. Now, as I mentioned, our first figure should be the sales in the sales budget. So what we are doing, we have been given the budgeted sales in unit 20,000, 50,000, 30,000 in each month, and in total it is 100,000. And we also have been given the $10 sales price. So the selling price is $10 in each month, assuming that there has been no changes in the selling price in the month. So for quarter it is $10. So it is simply the multiplication of the sales unit and the sales price per unit to get the total budgeted sales. Okay. So what we will be doing in the Excel, if we have the Excel. So if I have it is that this cell address is C3 and this cell address is C4. So here I would write C3 multiplied by C4. So as I have a single screen, I'm showing you the slides. I'm not working in the Excel in really, but you know that how this simple calculation can be done in the Excel from your computer application business course, right? Okay, now here we like to do the cash collections from the sale. So try to understand the assumptions. All sales are on account. Royal's collection pattern is in this way. 70% of the sales will be collected in the month of sale. 30% of the sales will be collected in the month following sale. In the month following sale. So what does it mean? Okay. Before showing you, let me complete here. In April, the March 31st account receivable balance of 30,000 will be collected in full in April. So we start from April, but you see in the April, there will be a number of collections. So first of all, we will collect an accounts receivable, which is from the March 31st. So this all 30,000 will be collected in April. So let me write here that 30,000 will be collected in April, cash collection. It is coming from the March, but again, we have this number, as I was saying, 70% will be collected in the month of sale. So out of this 200,000, 70% will be collected in this month, and 30% will be collected in the month following the month of sale. So 200,000 multiplied by 30%. Note that this 200,000 is the sales amount of which month? April, not the May. Now, cannot you complete for the May, for the June, and for the quarter in this way? So how it should work? So here you see what we are doing. We are collecting the accounts receivable which created in the April. In a similar way, we'll collect the account receivable which is created in the May. We'll collect it in June. But you see, out of the 500,000 sales in the May, we'll be collecting how much here out of this 500,000? How much of this sales will be collected in this month, May? That amount will be 70% or 350,000. Okay, you have written this number, so let me write here 350,000. So you see, if we complete, as I was saying, you have collected account receivable of how much? 30,000. It is off from the previous month. Okay, now you have collected 140,000 from where? From the sales of April, which is 200,000, but 70%, and 30% will be collected in the month following the month of sale. And now if we complete it, for the May, as you already have mentioned, that it should be 350,000, but we have made sales of how much? 500,000 in this month. So we have still account receivable amount of 150,000 to be collected in the month of June. So it is here. Now in this way, you have to complete all the months. And if you make a total of all of this, you'll see the quarterly figure. Okay. Now, so what will be the total cash collections for the quarter? What will be the total cash collections for the quarter? Write your answer in the chat box. You are giving the answer 730,000. So how you are getting this 730,000? You are saying 700,000 from the quarter column. Okay. So try to understand. Have we worked on the sales of June? It is complete up to May. Have we written here the June sales? June sales of how much? Yeah, 300,000. So out of this 300,000, how much is 70%? 210,000. Is it 210,000? So what you were saying earlier, 730,000. So 730,000 didn't account for the June collection, sorry, the sales amount collected for the June sales. Okay, this one 200,000. So if you add the 210,000 with the 730,000, you will get how much? 940,000. So don't do this mistake. Okay, good. So you got it. Let's proceed. So you already have calculated it now. So let's see, turn to the production budget. So as I was saying earlier, the sales is directly, the production is directly connected to the sales budget, and our production budget should be prepared in a way so that our production is adequate to meet the budgeted sales. This is one part. And another part is it is also adequate to prepare the to have the desired level of inventory, ending inventory. So we already have worked with this sales budget and expected cash collection from the accounts receivable. Okay. So let's work on the production budget. The management at Royal Company wants ending inventory to be equal to 20% of the following month's budgeted sales in units. So note that ending inventory should be equal to 20% of the following month's budgeted sales in unit. So it will be more clear when we have this, we have the figure, we know the budgeted sales for each month. So if the month is June, and if we have the May, and out of the sales of June, 20% of this amount, 20% of this amount should be the ending inventory in the month of May. Okay. So this will be the ending inventory in the month of May. I'll show you. On March 31st, 4,000 units are on hand. So these are the this is the ending inventory in the month of March. In the month of March. Now, note that again, if Royal Company was a merchandise company, it would prepare the merchandise purchase budget instead of the production budget. So here we are assuming that there is a manufacturing company, not the merchandise company. We have the sales figure, right? As it was before. We like to, before getting the numbers, let me make it clear. What should be the required production? Do not create confusion with how we make calculation for cost of goods sold. Okay, how we make the calculation for cost of goods sold? We add the beginning inventory, we make the purchases, and we subtract the ending inventory. In this way, we calculate the cost of goods sold. So this is something intuitive. This is something intuitive. Okay. Now, here we are not doing the cost of goods sold. Here we are wanting to know how much production I should make in a particular month. Try to understand. If I have the budgeted sale, and based on this, I'm preparing my, or I am trying to understand what should be the ending inventory in a particular month. Now it should be part of my production. That's why I am adding back with the production in the current month. Production in the current month, and I have the budgeted sales. I have the budgeted sales for each month. So for this particular month, the sales amount, I should prepare the amount which I will be selling. I need to prepare this amount. I also need to prepare another amount which is part of the ending inventory. And you see that in this way, for having the ending inventory in each month, I will also have some beginning inventory, a beginning inventory from the previous month. So you see, this is the total production needs, the sales plus the ending inventory, what I should have. Now, if I subtract the budgeted, beginning inventory from the previous month or from the beginning of this month, I will get the number which will tell me what should be the required production in this particular month. Is it clear? Why these numbers are plus? Why these numbers are plus? Why this number is minus? Is it clear? Straightforward? Yes. Good to go. What was said regarding the ending inventory? It should be 20% of which month's sale, which month's budgeted sale, the previous month or the following month. It should be the 20% of the following month. So let's check. So for April, the following month is May. And of 50,000, note that this is in terms of the dollar amount, right? This is in terms of the dollar amount, not in terms of unit amount, right? Is it? Sorry, let's check. Is it the dollar? No, these are in terms of the unit amount, not in terms of dollar amount. Yeah, it is in terms of units, not in terms of dollar. Okay, good. So you are saying that it should be, yeah, your belief is correct. Out of this following month sale unit, I will have 20% as ending inventory. So 50,000 multiplied by 20%, how much? 10,000. It should be my ending inventory. So in this April month, my total requirement is 30,000. But note that it has been said from the previous month, I have this 4,000 units in my hand. So this is my beginning inventory, 4,000. So if I subtract this inventory, what I already have, I will get the production needs in this current month. So this should be 26,000. So in this way, I can calculate for May, I can calculate for June, and I can get the sum figure for quarter. Okay. So you already have done this calculation, how this should happen. And I believe you'll be able to calculate this answer. What is the required production for May? What is the required production for May? Give me your answer using 30 seconds. Yeah, you have given the right answer. It is 46,000. So we have done it correctly. So we can complete it. We can complete it. Try to understand. Following month for June, which is the following month. It is not the following month. So what you will be doing mistake in the exam, you will think of this quarter as a following month. So you take 20% of this 100,000. So you'll put here 20,000. But what should be here? 20% sales of which month? 20% sales of the month July, which is given in the beginning of our question. Okay. So from there, we have this 20%. Now, in a similar way, we can prepare the budget for direct materials and also make a schedule for making the cash disbursement. Cash disbursement. Now we are not making the cash collection. We are making the cash disbursement. For what purposes? Because for purchasing the direct material or for paying to the direct laborers, I will have to make the cash disbursement. So let's see. There are some assumptions. At Royal Company, 5 pounds of material are required per unit of product. Note that for each unit of finished product, I require 5 pounds of direct material. In addition to this information, I have been said, management wants materials on hand at the end of each month equal to 10% of the following month's production. So what is said? It is also the part of inventory, but it is the inventory of what? Inventory of my finished goods or inventory of my raw materials. Inventory of raw materials. On March 31, 13,000 pounds of materials are on hand. Material cost is $0.4 per pound. Let's prepare the direct materials budget. Try to understand this is exactly similar to the process which we just have followed for the production budget. So let's try to prepare this together. This is our production, okay? From the production budget, we have this production figures for each month. Now we have to write down what are the materials required for, try to understand, it is the production of finished goods. So for each finished good, I need materials of how many pound? 5 pound. That's why it has been written in pound, okay? So I'll write here 5. In this way, what I will get? I will get the production needs of what? Production needs of direct materials. Okay, so let's calculate it. It is in this way: 130,000, 230, 145,000. Now, can you recall that it was mentioned that I should have a desired ending inventory, which is 10% of the following month's production? So if I have the desired ending inventory, the similar way we made calculation earlier. So out of this 230,000, it should be how much here? Desired ending inventory, 10% of the following month, 23,000. So I need direct materials of how much? 153,000. Can I recall that I have a beginning inventory of raw materials of this 13,000 for April? It is the ending inventory of raw materials from the March, but it is the beginning for which month? Beginning for April. Okay, so here I am writing the 13,000. In that case, what should be the production of the direct materials, or what should be the purchase of the direct materials? So that should be the difference of these two, 140,000. Okay, in this way we can what? So here is the calculation. We are already familiar, or we are already done with how can we work on this. Okay, so there is a question: why don't you calculate the materials to be purchased in May? Do you have the answer? To 221,500. Is it for what? Is for May. Okay, so you can calculate in this way. Let's proceed. How much materials you should purchase in the May? You already have given me the answer. Let me check your answer. You said the Same number, 221,500, which is this answer. Yeah, you have done it correctly. So we are already done, and we can complete the numbers here. And again, try to understand for the quarter, the quarterly figure. It is not altogether always the summation figure. It is not always the summation figure. Try to understand. It is the quarter of what? From April to June. And this quarter starts with which month? Beginning April. And this quarter ends with which month? June. So the beginning inventory of this quarter should come from which month? The beginning inventory of this quarter should come from which month? All months, or it should come from April? It should come from April, this one. Okay, so this one should be here. So don't do such kind of mistake. You might think that it is altogether the summation of all of this, not always. Okay, for the ending inventory, as I said, it is ends with which month? June. So ending inventory 11,500 should be the ending inventory of this quarter. Okay, so as we are saying that we need to make the cash disbursement for the materials. So accounts payable created, right? Accounts payable creates for what? For purchases of materials. So how we make payment? So it is said that Royal pays $0.4 per pound for its materials. Try to understand, per pound. So we need the materials figure, total materials requirement or total materials purchase figure in terms of pound, not in terms of dollar. This pound is not the Great Britain pound. This pound indicates what? This pound indicates weight. Okay, this pound indicates weight comparable to kilogram. Okay, 1/2 of a month's purchases is paid for in the month of purchase, the other half is paid in the following month. In the similar way, we made calculation for accounts receivable collection, but here you see half will be collected in the month of half will be paid in the month of purchase, and half will be paid in the following month. So the March accounts payable balance is 12,000. Let's calculate the expected cash disbursement. Now let me ask you, before showing you the calculation, in the month of April, what should be the payment for accounts payable created in March 31? What should be the payment for the March accounts payable? What should be the payment in the month of April, but for the accounts payable which were created in the month of March? $24,000. How? March 31 accounts payable balance is 12,000. Okay, let me show you. We have the accounts payable from the March 12. It was 24,000 in total. So we have the remaining accounts payable 12,000 to be paid. So in March we have total 24,000. So we are paying half in the March, and we are paying remaining half in the month of April, following the month of March. Okay, or following the month of purchase. Now let's work for the remaining. Can you recall the April purchases? April purchases, if you look at the previous figures, that was the 56,000. So out of the 56,000 purchase figure in the month of April, I'll be paying half in the month of April and the half in the month of May. So 56,000 out of 56,000, 20,000 will be paid in April and 50% will be paid in May. In this way, you prepare for May. and you prepare for June. Okay, so now try to remind you that this was the total requirement of the direct materials, 140,000 LBS. LBS is the symbol of what? LBS is symbol of what? Have you seen it? Yeah, LBS is symbol of pound. Okay, so in this way we are making the cash disbursement. So for May, what I would write? I would write 50% of the total purchase bill and 50% of the total purchase bill, but 50% will be in the month of current month and 50% will be in the following month. Okay, let's see. In the month of May, we had how much production needs? 230,000, right? Sorry, it was the production needs. We need this figure, the materials to be purchased from the suppliers, 221,500. So 221,500 multiplied by this one, 0.4, right? So 221,500 multiplied by 0.4, how much? How much it is? It is 88,600. So out of the 88,600, how much I'll be paying in the month of May? Half. I'll be paying half in the month of May. That is 44,300. And when I'll be paying the remaining half, 44,300 in the following month. So in this way. And for June purchases, I'll be paying half of the purchase payment in the month of June and the half in the month of July, which is out of the current quarter. Okay, so here in this way we are calculating. Okay, so you already have calculated. So that is all about for today's class, and we have a remaining discussion with other budgets which are part of the master budget that will be discussed later. Now we like to prepare a direct labor budget in continuation of the master budget. So here we see that we have been given some information for preparing the direct labor budget. We have been said that at Royal, each unit of product requires 0.05 hours, 3 minutes of direct labor. So you can recall that Royal is our company that is producing some product, and each product requires this amount of direct labor. And you see it has been measured in terms of the duration of the direct labor. The labor can be unskilled because the production process is relatively simple and formal training is not required. Royal pays its workers at the rate of $10 per hour. So you see that we should start with which one or which item or which variable to calculate the direct labor. We have been given the direct labor requirement for each product, each unit of product. Now let me ask you, what should be the first line or first item we should have for calculating the direct labor budget? Any idea? Should we come up with the sales number? Or should we come up with some production units? Which one? Units of sales or units of production? Obviously units of production, right? So from the we already have calculated what should be the production in each month in our previous calculation. So we have brought this number here. So units of production in each month. So you see that we have come up with these production numbers from which budget? From the production budget. Okay, it is units under the in terms of unit. So we have been said that for each unit of production, we need to have how much labor hour. We need to have 0.05 labor hour or 3 minutes. So we can compute the total labor hours by multiplying the labor hour per unit of product and get the total labor hours for this total production. Okay, so if we multiply this, we have this labor hours, right? Now, we also have been said, or we have been said that you see that these are in terms of what? These are in terms of hours. We have been said as these are unskilled labor, we pay $10 per hour, $10 per hour. So what can we do? We can multiply the labor hours by $10 for what? For getting the total direct labor cost. Okay, so here it should be very simple. It should be like this, right? So we should have these numbers: 13,000, 23,000, and in total quarterly 50,500. Now, if we make the assumption, that this cost for what? Direct labor cost is paid when it is incurred, will we have any wages payable? If we assume that we make payment of the direct labor when we incur this, will we have any wages payable? We will not have any wages payable. Okay, so that is the assumptions we have made. So if we have accrue some wages, which you will see in some exercises, what will happen? You will have to work in a way that how we work in accounts payable in terms of the purchases of direct materials. You can relate that. Okay. So we have worked three months together, right, at a time, and we have not. If we have the accounts payable, our month's payment would be linked. But right now we have no linkage among these months because we do not have any accounts payable, sorry, wages payable, or we have not made any payment like advance payment of wages, right? So if this thing happens, you need to think how it would happen. Okay. Now we like to prepare a manufacturing overhead budget. You can recall that this is the most challenging part, how to allocate the manufacturing overhead. We spend much of our time to understand the manufacturing overhead. So here we have been given some information for accounting the manufacturing overhead in this way. Manufacturing overhead is applied to units of product on the basis of direct labor hours. Try to understand what is it. Allocation basis, allocation base, right? It is the allocation base. And the variable manufacturing overhead rate is $20 per direct labor hour. And we have been said the fixed manufacturing overhead is $50,000 per month, which includes $20,000 of non-cash cost, primarily depreciation of plant assets. So we have been given two types of manufacturing overhead in terms of the cost behavior. One part is variable, another part is fixed. So how can we come up with the total manufacturing overhead cost? So let's prepare some manufacturing overhead budget. Okay. Now let me ask you, in terms of the information given, what should be the first line item in the manufacturing overhead budget? Should it be something like production units or sales unit? Yeah, Jubair, you have given the right answer. It should be the direct labor hours. As we have been said, the direct labor hours is the baseline. Okay, so let's start with the all. As we already have calculated the budgeted direct labor hours, we have taken these numbers from there. Okay, so we have been said the variable manufacturing overhead rate is how much? We have been said the rate is $20 per unit. $20 per unit. So let me check again. Yeah, $20 per unit. So we have taken the $20, and now if we calculate this, we have some variable manufacturing overhead cost, right? Can you recall that you also have been given some fixed manufacturing overhead cost, which is around how much? 50,000. 50,000. So let's write this fixed manufacturing overhead, 50,000. Have you come up with this number? The variable manufacturing overhead, total variable manufacturing overhead number. The number is 26,000. So if we write that 26,000 here and we add these two numbers, we have the total manufacturing overhead expenses of how much? 76,000. Okay. Now you see, out of the 76,000, have we made all cash payment, or we might have some non-cash expenses under the fixed manufacturing overhead? You can recall that plant depreciation of the plant asset 20,000 is a non-cash expenses. So do not need to make any expense cash outlay for this 20,000. We have to make cash outlay for how much? We have to make cash outlay for 56,000. So in this way, we can come up with some number for what? For the cash disbursement of manufacturing overhead, right? Have you got it? So in this way, we can work for each month, May, June, and we can come up with this number. So what is this? These are, okay, we have this manufacturing overhead expenses in total, but what can we do? We can calculate what can be the predetermined manufacturing overhead rate. What can be the predetermined manufacturing overhead rate? Now you might ask why it is essential. It is essential to allocate the cost of predetermined manufacturing overhead rate. So as we have been given the information for this, that's why we have added it. But we might have some production units which might be in the inventory, for which will not be given some precise numbers for the manufacturing overhead. Then what can we do? We can use this number for calculating the manufacturing overhead for that inventory. So how can we calculate the predetermined manufacturing overhead rate? You see, the total manufacturing overhead rate in this total quarter, April, May, June, is how much? 251,000. 251,000. It is our total manufacturing overhead. We are familiar with this kind of calculation. And during this time, we are estimating, note that it is the budget, right? We are estimating how many direct labor hours we'll be spending for our production. So it is 5,050 for our budgeted production. So we are estimating our predetermined overhead rate based on the per direct labor hour. So how much it is? 0.4970. So I will show you that when it will be useful. Right now it is not useful here, but this calculation is essential for working with some numbers later. Okay. So as I was saying previously, that depreciation is a non-cash expenses. What can you do? You can adjust this for what? For making or for getting what amount will be the actual cash disbursement for manufacturing overhead in this way. Okay, this is a straightforward. Now, we have to calculate the cost for finished goods inventory, ending finished goods inventory. We have been given this information, direct materials. Can you recall in the direct materials budget, for each unit of production, we require 5 pounds of direct material. Can you recall this? Can you recall the information given? We work in the direct materials budget, okay? And for each pound, the direct material cost is $0.4. So for each unit of product, note that it is, I'm not saying for each unit of material, I'm saying for each unit of product, how much direct materials cost you have to incur? It is the $2. How can you get this? 5 pound, it is the 5 lbs in terms of weight, and each lbs or each pound cost how much? $0.4. So it is the $2. Now, in the similar way, we can calculate the direct labor cost. We can calculate the direct labor cost. How can we calculate the direct labor cost? What should be here? What should be here? How much direct labor I require for per unit of product, right? So you can recall from the direct labor budget, we require 0.5 hours, 05 hours direct labor hour, which was equivalent to 3 minutes. Okay, it is here. And we also have been given that per hour we pay how much? $10. So if we multiply this, we get the cost for what? We get the cost for direct labor. Now, if I ask you the manufacturing overhead rate, manufacturing overhead per unit, how can you come up with this? You have been given no manufacturing overhead cost total per unit. Variable manufacturing overhead is given per unit, right? But the fixed manufacturing overhead has not been given to you per unit, right? So how can you come up with the manufacturing overhead per unit? You can only come up with the manufacturing overhead per unit if you have the predetermined manufacturing overhead rate, which we calculated a few seconds ago, right? So it was how much? It was, we calculated, let me take the number. It was 49.70. Okay, so let's proceed. Yeah, so 49.70 per hour, 49.70 per hour. But for per product, how much direct labor is required for? Per hour cost is 49.70. But for per unit of product, you need direct labor of how much? 0.05 hours. Now you might ask that in manufacturing overhead, why we are taking the per product direct labor hour? Because we are allocating the manufacturing overhead based on the direct labor hours. That is the reason that why the base are same here. Okay, have you got the answer? So in this way, we have this number. Okay, so for each unit of product, how much production cost I'm incurring? I'm incurring $4.99. Now, if I have this $4.99 as a unit product cost, and if I have been given the ending inventory in unit, is it possible to come up with the ending finished goods inventory cost? It is clearly possible. Okay, so you can recall that in the quarter, we have the 5,000 ending inventory. You can recall it from our previous calculation of the purchase, production budget. There you would see the 5,000 ending inventory. So 5,000 ending inventory multiplied by 4.99, we have this cost for ending inventory for finished goods. Okay, so it comes from where? It comes from the It comes from the finished goods budget. Sorry, it comes from the production budget. Okay. So here we are already done. Now let's proceed to something which is the selling and administrative expenses budget. It will be very much straightforward if you understand the previous discussion. So we have been given some information. Similar way, at Royal, the selling administrative expense budget is divided into variable and fixed components. The variable selling administrative expenses are $0.5 per unit sold. And we have been said the fixed selling and administrative expenses of 70,000 per month. Similarly to the manufacturing overhead, we also have been said the fixed selling administrative expense includes some non-cash expenses of 10,000, which is primarily for the depreciation, that are non-cash outflows of the current month. Okay, so let's prepare the company's selling and administrative expenses budget. Okay, now let's proceed. You see that variable selling and administrative expense, it is given in terms of what? It is given in terms of the unit sales. It is given in terms of the unit sales. So we should start with what? We should start with which number? We should start with the number which is the sales unit. So let's start with the number sales unit. Now, if we have the sales unit, we can then follow the variable sales and administrative expenses rate, which is $0.5 per unit, which is here. And we will multiply these two, then we get the variable selling and administrative expenses of 10,000. In addition, we have been said that in addition to this, we incurred how much fixed selling and administrative expense is about 70,000. So if we add 70,000 at fixed selling and administrative expense, we have how much in total? 10,000 plus 70,000, which is the 80,000 total selling and administrative expenses. As before, we worked in the manufacturing overhead, we asked that how much cash outlay you have to make out of the manufacturing overhead. So here I asked the same question, how much cash expenses you have to incur for the selling and administrative expenses. Now you might ask that why we are much concentrated, or we are thinking of the cash, okay? Why we are subtracting non-cash. So note that for non-cash, you do not need to look for, you do not need to think for financing, borrowing, this additional financing, okay? So your financing will actually be required for the cash outlay, okay, estimated cash outlay. That's why we are actually hiding, or we are actually what I'd say, we are neutralizing, we are filtering the expenses for the cash amount, okay? So now non-cash expense 10,000 has been subtracted, which is again for depreciation, and we have the remaining 70,000, which is for cash selling and administrative expenses. In a similar way, we can work with for month May. We can also work with for month June. Okay, so let's complete it. So this will be the complete picture for selling and administrative expenses. Now, this is the final thing, the prepare a cash budget. I again like to draw your attention, because you need to prepare the cash budget most frequently in your real life. So cash budget and understanding the structure of cash budget is very critical, and it will be very much useful. Okay, and it is very much testable also. So let's see. So cash budget has 4 sections broadly. First section is cash receipt. So from this name, you can understand what will come here. The cash inflows will come here, which will not come here. It will not include the cash coming from the financing, because cash coming from the financing will be included in separate section, which is the financing section. Okay, so cash receipt will include only the regular cash inflows. Regular cash inflows can come from sales, can come from if you look at the financial statement, cash can come from selling asset in this way. But usually we note the regular cash inflows here, which come from the sales. Okay. The cash disbursement, which cash disbursement will be included here? Only the cash payment for the regular activities. So what are the regular activities? We have the regular activities for production. We have the regular activities for direct labor. We have the regular activities for manufacturing overhead. So for this, we have to make cash payments. So this will come into this section. Note that it will exclude all expenses for payment of interest, for payment of loan, because that will come into the financing section. Now, by subtracting the cash disbursement from the cash receipt, you have another section, which is here. We are saying either you might have excess cash or you might have deficiency of cash. Okay. So this section will help you to determine how much you need to borrow or how much money you have extra, so that you can think for whether you can repay the loan what you borrowed earlier when you didn't have the excess cash, or you had the deficit cash. Okay. And the financing section will detail what issues. It will show you how much borrowings we are making and how much repayment, including principal and interest, we are expecting to make during the budget period. Note that all these are part of the budget, and all this will be based on some forecasted numbers. Okay. So we have been given some additional information in addition to the information with which we are already working to prepare the cash budget. So it has been said this company maintains a 16% open line of credit for $75,000. I firmly believe that you have come up with this concept line of credit from your financial management course, and you know that what does it mean, and how financing is available in this way, right? So this company maintains a minimum cash balance of $30,000. So regardless of the surplus or the deficit, this company tries to maintain how much cash balances? $30,000. And this company borrows on the first day of the month and repays loan on the last day of the month. Okay. And this company also pays cash dividend of $49,000 in April. Note that it has been pays, say pays, but actually it is a forecasted number as long as it is budget. This company purchases $143,700 of equipment in May and $48,300 in June. Both purchases are paid in cash, and this company has an cash balance, beginning cash balance of April 1, which is the $40,000, is the ending cash balance of the previous quarter. Okay, it's very straightforward. So let's see. This is the cash budget starting. Try to understand the section first before hung up with the working. Here, we will show the cash receipt in this part, in this section. Here, we will show the cash disbursement, okay, in this second section. Here, in this section, we will show the excess or deficit. In the final section, we will look at the financing part. Very clear? So let's work. So beginning cash balance, as we said in the previous slide, we have the beginning cash balance of 40,000. So this cash is available with us. That's why we have written it here, 40,000. And now cash collections. Can you recall cash collections come from where? Cash collections of this firm comes from which sources? Very precise. I'm asking for something from you. Does it come from the sales or it comes from the collection of accounts receivable? Sales creates the accounts receivable and you generate the cash from the accounts receivable. Can you recall that we defined the cash collection in terms of account receivable? Either way, you're correct. Sales is expressed in terms of the accounts receivable. So you can say it comes indirectly, all cash comes from the sales, but it actually comes from the collection of accounts receivable. Okay. So collection of account receivable can occur in the month in which you have made sales, or it can be collected in the following month. Okay. So from collection of account receivable, this 170,000 has come. Okay, you can recall, I'm not showing you the schedule with which you worked earlier. Okay, now, so we have this cash available to 10,000. 40,000 beginning, 170,000 collection in the April, that is in total to 10,000. Now, from the materials budget, we noted we have to incur 40,000 cash disbursement. For direct labor, we already have calculated we have to incur 30,000 cash outlays. For manufacturing overhead, we have to incur 56,000 cash outlays. For selling and administrative expenses, we have to incur cash outlays of 70,000. Now, can you understand all of this? All of these numbers are coming from some budgets which we already have prepared. These are not something which we are producing here directly. These are numbers which are coming from some budgets with which you already have worked, right? So here are these numbers, okay? So these are come from the materials budget. These are come from the direct labor budget. These are come from the manufacturing overhead budget, selling administrative expense budget, and equipment purchase, dividend. These are something new. So equipment purchase information is given to you, dividend information is given to you. Now let's see. The additional information is not saying the equipment purchase has been made in April. Let me take you to the information. What has been said regarding the equipment purchase? It has been said we made purchase of equipment in the May and in the June. That's why the number is blank in the April. But it has been said the company pays dividend of how much? 49,000 in which month? In the April month. That's why the 49,000 is here. Okay. So if we add all the cash disbursement, this will give us how much cash disbursement? 228,000. Now, if we subtract this 228,000 cash disbursement from this cash received or cash available in this April month, will we have surplus or we have the deficit of cash? We have the deficit of cash or we have the surplus of cash? We have the deficit of cash of how much? Is it 18,000 deficit? So as long as it is deficit, we are writing it in the terms of negative or in this way. The deficiency will be noted in terms of first bracket. Okay. So because Royal maintains a cash balance of 30,000, you see that this is in short of the cash balance what Royal wants to maintain. Royal wants to maintain how much cash balances in each month? Royal wants to maintain how much cash balances in each month? Royal wants to maintain cash balances of 30,000. Now, if you want to make cash balances of 30,000, now if you have the deficit of 18,000, how should you make repayment of loan or you should make additional borrowing? You can make additional borrowing. Now, the question is how much borrowing you have to make? It is the 30,000. It is the 30,000 or 12,000 or 18,000 or something different from these three numbers. The number is 48,000. So how it is 48,000? You see that you have to refurbish the 18,000 first. Now, if you refurbish it, then you add 30,000. Sorry, you add 30,000. Then you have the 30,000 cash balances. Otherwise, it is not possible. Okay. So you should have ending cash balance. Okay, let me write here the first here 30,000. You want to maintain this. You want to maintain ending cash balance of 30,000. As you have said, for having this 30,000 ending cash balances, how much borrowing I should require? 48,000. Will you make any repayment here? Will you make any interest payment here? How much financing I'm making here in total? 48,000. Okay, so in this way we can fill it up. Have you got it that how we are working here? Try to understand. I have written the 30,000 ending cash balances first. Then I'm trying to understand how much borrowing I should require to have the 30,000 cash balances here. So you have given me the answer. I should have the 48,000 borrowing. So that's why I have written the 48,000 here. And this is the summation of all the financing issues. Okay, so let's work here. So as we said, for having the 30,000 cash balances, we need to make the 48,000 borrowing. And the April month is completed now in this way. Now, in the following month, May, you see that we have the excess cash or the deficit cash. We have the excess cash. Now, the follow-up question to you: do you think this cash is sufficient for making the repayment of this borrowing what we made earlier in the month April? And after making this repayment, we will have the 30,000 minimum cash balance here. Do you think this 40,000 is sufficient? The 40,000 is not sufficient. So what can we do? We can keep it as it is. We cannot do anything here. Should we make any additional financing? Should we make any additional financing to have the minimum cash balance of 30,000? No. Now, let me ask you, instead of having the 40,000 here, if the number is 20,000 here, should we make additional financing here? How much? If I have the 20,000 cash, excess cash, should we make financing? So you are saying that then we should make financing of 10,000. So if I make the 10,000 financing, in that case, I will have the 30,000. So this 30,000 is the minimum requirement. So you can have a balance which is above the 30,000, but this number cannot go beyond, cannot go below 30,000. So it should be the minimum 30,000. So let's return to the next month, June. Cannot we make a partial repayment? The answer is no. We make in reality, but here for simplicity, for convenience, we will not make such repayment. We'll make repayment at a time. Okay. So note it. If we make a partial repayment, that can happen, but that will create the situation cumbersome. Okay. Situation means the calculation here will make something cumbersome, but that is possible if your financier permits you. Now, in the month of June, we see the cash balance of 130,000. Now, the question is to you: do you think this 130,000 cash, 130,500 cash is sufficient to repay this 48,000 borrowing and the interest payment accrued on this 48,000, and still we have 30,000 cash balances in the ending cash balances. Do you think this amount is sufficient? This amount is sufficient. Obviously, the number is too big. So let's work it. How can we make repayment? Okay. Note that we have a principal borrowing amount of how much? We have a principal borrowing of this 48,000. We have a principal borrowing of this 48,000, and we have used 48,000 for how many months? What do you think? We have used the 48,000 borrowing for how many months? For 3 months. How it is 3 months? Why not 2 months? Can you recall that there was a saying that the company pays the repayment of loan in the ending of the month, So when we are saying the repayment in the June, we will make the payment in the June 30, not June 1st. If it is June 1st, in that case, it will be for 2 months. So how can we make calculation for interest? That will be kind of very simple calculation. 48,000 amount, 48,000 borrowed amount, and line of credit. Can you recall that interest percentage was 16%, and we have used amount for how many months? 3 months. So for 3 months, it will be 1,920. So this is the repayment of interest. So in total, how much repayment we need to make? 49,920. 49,920. What we are doing? We are borrowing here, or we are making repayment? So we are making repayment here. So when we are making repayment of 49,920, will this excess cash balance will go up or go down? It will go down. Now, it will go down by how much? By the amount for which we have made the repayment of loan. So after making this repayment, we have this 80,580. It is much above the 30,000 minimum cash balance. It is more than double. It is more than double. 30, more than double, right? So we are done with the cash budget. We are done with the cash budget. Now, by taking the interest expense from the cash budget, we can now work for the budgeted income statement. So it is very much straightforward if you think of the conventional income statement. So can you recall the conventional income statement? It starts with which item? Conventional income statement starts with which item? Sales item. So sales is already available with us, right? So sales is here. So we are preparing the income statement not for single month, for a quarter. So for the quarter, which is ended in June 30, we are preparing the income statement. So in whole quarter, we have a budgeted sale of 100,000 at the rate of $10 selling price, and we have this sales budget number. Okay, and we already have learned how to calculate the cost of goods sold. Can you recall this 4.99? How you have calculated it? Summation of direct materials, summation of direct labor, summation of manufacturing overhead, all are per unit. Can you recall the 4.99? So this 4.99 multiplied by this sales unit, then you can get the calculation of cost of goods sold. This is here. And if you subtract the cost of goods sold from the sales unit, what will happen? What will be the remaining? The remaining will be the gross margin. Okay. Alternatively, you can look at the finished goods inventory, and you can finished goods inventory value. And if you subtract the finished goods inventory value, you can come up with the cost of goods sold. And the difference between the sales and cost of goods sold is the cost of gross margin. And we already have worked with the sales and general administrative expenses, which is we see the cash outlay is 260,000. And we have, after subtracting this, we have the operating income. And just immediately we have recognized that in the whole quarter, we have made the interest expense of how much? 1,920. So this should be our interest expenses for the whole quarter. And after having this interest expenses accounting, we have the net income. We have the net income after subtracting the interest expense. This is very much a straightforward, very plain vanilla income statement. Okay. Now for preparing the balance sheet, budgeted balance sheet, you can recall that most of the items with which we have worked, most of the items are numbers or items for the income statement. We have a very limited numbers, or we have a very limited items for the balance sheet. So you can recall that we made purchase for equipment in month of May and June. So we have some number for balance sheet, but still some additional information for Royal have been provided to you for preparing the budgeted balance sheet. You see the land is 50,000 at the end of the June quarter, common stock of 150,000, retained earnings in the beginning of the quarter 248,650, equipment of 175,000. Can you recall this 175,000? Let me show you. We made purchase of equipment. Where it is? Probably, yeah. It's not matching. Okay, let me check whether they have said the equipment of 175,000. Probably what has happened, they have accounted for depreciation, and this is the ending balance of the equipment. Okay, so we'll follow the additional information here, and here are the numbers. So let's try to identify from where these numbers are coming. This cash balances is coming from where? This cash balances is coming from, can you recall that we just have prepared the cash budget? So from cash budget, let's check which number it should be here. Which number should be here? The ending cash balance, because we are preparing the balance sheet on the end of or on the last date of the June. Okay, so this cash balance is from here. Now accounts receivable is coming from it is coming from our earlier numbers, and raw materials inventory we already have worked with. Finished goods inventory we already have worked with this. The finished goods inventory, you can recall this calculation. Okay, land has been given additional information. Equipment 367,000. You see now. It is probably we have how much from the 192,000 from the purchase of the equipment, 192,000, and how much is from our additional information? 175,000. Is it the summation of two? I see it is the summation of two, 367,000. Okay, so this is the summation of all assets. And accounts payable is coming from our forecasted budget for the payment of purchases. You can recall that there was a ending balance for accounts payable, and common stock has been given here, and we need to come up with the retained earnings number. You can understand that how retained earnings is calculated from your financial statements analysis or financial reporting codes. We need to have the beginning retained earnings, which is here, beginning retained earnings, right? Then we have to add what? We have to add what? This one, net income. current period net income. Now, then what we have to subtract? We have to subtract any repayment to the equity holders. You see that we have made dividend payment. So if you work with this, you can come up with the ending balance of retained earnings. Okay. So in this way, we can get the total liabilities and shareholders equity. And this is the calculations is given here. But I was saying that how it is possible to find out this number. And this is how the cash budget or master budget works. And master budget is a big thing. And cash budget is a thing which is dependent on number of budgets. And from the cash budget, it is possible to prepare the budgeted income statement and the budgeted balance sheet. So all these budgets are components of master budget. So that is the ending. Okay.